Alright, let's get right into it. The word amortization sounds super complicated, like something you'd hear in an advanced finance class you'd want to sleep through. But it's actually a pretty simple idea once you break it down. Understanding it is one of the most important things you can do for your financial health. Think of it like a plan, a roadmap that shows how you'll pay off a big loan over time. It's the process of spreading out your loan payments into a series of fixed, regular installments. Each payment you make is split into two separate buckets. One part goes toward paying down the interest. The other part goes toward paying down the amount you borrowed. The principal. It's that simple. So here's the deal. When you first get a loan, whether it's for a house or a car, the bank has given you a massive pile of cash. In return, they charge you interest for the privilege of using their money. Amortization is the system they use to make sure they get their interest money while you slowly chip away at the original loan amount. Early in the loan, your payments are heavily skewed toward interest. A huge chunk of your money goes straight to the bank as a thank you. As time goes on, with consistent monthly payments, the balance starts to shift. Less money goes to interest, more money starts hitting the principal. That gradual shift is amortization in action. Imagine a giant boulder of debt. At first your hammer swings, your payments only chip off tiny flakes of interest dust. The boulder barely seems to shrink. Keep swinging and you wear down the interest layer, then your swings start taking bigger chunks of the actual boulder, the principal. Over the loan's life you move from mostly paying the bank to actually paying for the thing you bought. So why should you care about any of this? It's just a bunch of financial jargon, right? Wrong. Understanding amortization is like having a superpower, especially for your biggest purchases. When you don't understand it, you're flying blind. You make the monthly payment, money disappears from your bank account, you assume it's working out, but when you know the mechanics, you can see how much of your payment is just bank interest, how much is building your ownership equity in your home or equity in your car. It's the difference between passive and active management of your wealth. This knowledge changes how much you pay over the long run. The sticker price isn't the final cost. The final cost includes years or even decades of interest. Amortization shows the whole cost. In the first 5 years of a 30-year mortgage, you've paid tens of thousands, but your loan balance barely budged. It's a wake-up call. So you attack principal more aggressively, save money, shave years off your term. Understanding this helps you borrow smarter. When shopping for a loan, look at more than the monthly payment. A lower monthly might be because the loan is stretched out. That can cost you thousands more. Amortization lets you compare offers properly, see how rates and terms affect total cost, pick the loan that truly saves you most. Ultimately, it's about financial freedom. Pay down principal faster, eliminate debt sooner, get rid of a car payment or a mortgage payment, free up tons of monthly income. Use that money to invest, save for retirement, start a business, live with less financial stress. Ignorance here is expensive. Learn this once. It pays dividends for life. Alright, let's make this real. An example that almost everyone deals with. A car loan. Car loans are a perfect way to see amortization in action over a shorter time frame, like 5 years or 6 years. Let's say you want to buy a car for $30,000. You don't have that kind of cash just sitting around, so you go to the bank and get a loan. The bank agrees to give you the $30,000. You agree to pay it back over 60 months. That's 5 years, at a 6% interest rate. After you run the numbers, your fixed monthly payment is exactly $580. Great, you can afford that. But where does that $580 actually go? For your very first payment, the bank needs to calculate its interest first. They take your outstanding loan balance, $30,000, multiply it by the annual rate, 6%, then divide by 12 to get 1 month's interest. 30,000 times 0.06 is 1,800, divide by 12 equals 150. For your first payment of $580, a full $150 goes to interest. It's gone. The remaining amount, which is 580 minus 150, equals $430. That $430 is what actually gets applied to your principal, reducing your loan balance from $30,000 down to $29,570. Now let's look at your second payment. The process is exactly the same, but the numbers are slightly different because your loan balance is now a little bit lower. The bank calculates the interest based on your new balance of $29,570. So, $29,570 times 6% divided by 12 gives you about $147.85 in interest. Notice it's a little less than last month. Your payment is still the same fixed amount of $580. So, this month, You subtract the $147.85 in interest from your $580 payment. That leaves $432.15 to go toward your principal. Your new loan balance is now $29,137.85. You're making progress. This cycle repeats every single month for 5 years. With each payment, the interest portion gets a tiny bit smaller, and the principal portion gets a tiny bit bigger. By the time you get to your very last payment, number 60, the situation is completely flipped. Your outstanding balance is only about $577. The interest for that final month is incredibly small, maybe around $2.89. So, when you make your final $580 payment, almost all of it goes directly to wiping out the last bit of principal. And just like that, after 60 payments totaling $34,800, you've paid off your $30,000 car and are officially debt-free. That extra $4,800 was the total interest, your cost of borrowing. Now let's scale this up to the biggest loan most people will ever take on, a mortgage. This is where understanding amortization becomes absolutely life-changing because the numbers are so much bigger and the timeline is so much longer. Let's imagine you're buying a home for $400,000. You make a down payment and you take out a mortgage for the remaining $350,000. For this example, we'll use a 30-year fixed-rate mortgage with a 7% interest rate. When you plug those numbers into a calculator, you get a monthly principal and interest payment of about $2,328. That's your payment for the next 360 months. It seems straightforward, but the amortization is brutal in the beginning. Let's break down that very first mortgage payment. Your loan balance is a massive $350,000. $350,000 multiplied by your 7% interest rate, which is 0.07, equals $24,500 in annual interest. Divide that by 12 months, and you get a staggering $2,041.67. That's just the interest for 1 month. So, when you make your first payment of $2,328, over $2,000 of it immediately vanishes to pay the bank's interest. Only the tiny remaining amount, just $286.33, actually goes toward reducing your $350,000 loan. After your first payment, your new balance is $349,713.67. It barely moved. This is why the first few years of a 30-year mortgage can feel so defeating. You're making huge payments every month, but your loan balance just isn't going down very fast. Let's fast forward 5 years or 60 payments in, you've paid a total of $139,680 out of your pocket. You'd think you'd have made a serious dent in your loan, right? But because of front-loaded amortization, the vast majority of that money went to interest. Your loan balance will have only decreased by about $21,000. Your new balance is still around $329,000. You've paid nearly $140,000, yet you still owe almost 94% of the original loan. It's a tough pill to swallow. It's not until you reach the halfway point of the loan, around year 15, that things really start to shift. At this point, your monthly payment finally starts being split more evenly between principal and interest. From that point forward, every payment you make has a bigger and bigger impact on your principal balance. In the last 5 years of your loan, the situation is completely reversed from the beginning. Your payments will be almost entirely principal, with only a few dollars going to interest each month. Over the full 30 years, you will have paid a total of $838,080 for that $350,000 loan. That means you paid over $488,000 in interest alone. That's the power and the danger of long-term amortization. So how can you keep track of all this without doing complicated math every single month? The answer is the amortization schedule, or amortization table. This is one of the most powerful but underutilized tools a borrower has. When you get a loan, you can and absolutely should ask your lender for this schedule. It's essentially a giant spreadsheet that lists every single payment you will make over the life of the loan, from payment number 1 all the way to payment number 360 on a 30-year mortgage. It's your complete financial roadmap, no guessing, it's all laid out for you. Each row represents one monthly payment. Columns typically show payment number, total payment amount, same each month, portion to interest portion to principal remaining loan balance. Early on, you'll see huge interest numbers and tiny principal numbers. Scroll down and you'll see interest slowly decrease while principal slowly increases. That visual proof is motivating. When payments feel pointless, the schedule shows when things turn a corner. You can see the exact month principal surpasses interest, a major homeowner milestone. That's the crossover point. Example, 30-year at 7%, crossover around year 18. Seeing it on paper can make you want to beat the schedule. It turns a scary number into a manageable plan. You don't need your bank. Free online amortization calculators exist. Plug in loan amount, interest rate, loan term, and get the full schedule in seconds. Play with numbers. See higher rate raise total interest. See savings from a 15-year versus 30-year mortgage. An amortization schedule is your crystal ball. It lets you see the consequences of decisions before you make them, which is an unbelievably powerful position to be in. Alright, so now that you understand how amortization works against you in the early years, let's talk about how to fight back. The secret weapon is making extra payments toward principal. Because interest is calculated each month on the outstanding balance, any extra dollar toward principal creates a ripple effect that reduces future interest. It doesn't just lower this month's balance, it lowers interest every future month. This can save you an insane amount of money and time. Here's how. When you make an extra payment, tell your lender to apply it directly to principal. If you don't, they may apply it to next month's payment and you get no benefit. Example, a $350,000 mortgage. Regular payment, $2,328. You pay an extra $100 toward principal in month 1. That $100 immediately lowers your balance. That $100 is no longer accruing 7% interest for the next 30 years. That single extra payment could save you hundreds over the life of the loan. Imagine making it a habit. 1 extra payment per year. How to do it. Divide your monthly payment by 12 and add that to each month. On $2,328, that's about $194 extra per month. Doing this cuts a 30-year mortgage to just under 24 years. That's more than 6 years shaved off, and you save over $109,000 in interest. Think what you could do with that $109,000. It's a game changer. The key, be consistent. Small amounts add up because amortization then works for you. Some people round up to the nearest 100. Others use bi-weekly payments, which results in 1 extra payment per year. Whatever you choose, attack principal early and often. Sooner is better. You prevent future interest from ever being calculated. That's how you take control of the amortization schedule instead of being a passenger. So let's wrap this all up. Amortization is just a fancy word for a payment plan that pays off a loan over time, but it's heavily front-loaded with interest. This knowledge is meant to empower, not discourage. It's the first step to smarter financial decisions. You are now in control. You've moved from passive borrower to savvy financial manager. You know the rules and how to win. Never blindly send a payment again. Use the knowledge to your advantage. Analyze loan offers, make strategic extra payments, and get out of debt fast. Thank you so much for watching. If this helped, smash that like button, hit subscribe for more, and drop your questions or thoughts in the comments below.